So, happy Thursday, everyone. Here, it's Greg Dixon with the Note Center. I'm here with Maurice Thomas Jr., and we're in the lesson two of his summer school for note investing. And the topic today is understanding the mortgage note market. And Maurice has a presentation here that we can go through.
Absolutely, absolutely, and that's a great call out, Greg. Thank you for that introduction there. As it relates to the presentation, we heard your feedback. We understand that we have different types of learners out there, so I put together a deck for you to kind of follow along. And just to maximize our time here, we're going to be very efficient with our time, keeping these meetings less than 15 minutes. But welcome to the Mortgage Note Summer School Series. My name is Maurice Jr. I am a mortgage note investor, group home, and shared living space owner. I'm a mentor and an asset manager. I thank you for, just being here and exploring this opportunity as it relates to discovering your opportunities when it comes to, financial knowledge in this space, coupled with growing your wealth. Overall, today's topic is going to be understanding the mortgage note market. We touched on quite a bit of topics during our last session here. So today, we're just going to dive straight into it, and do an overview of the mortgage note market itself. So just to give you an idea of the definition or just a recap, um, let's let's explore the recap overall. Okay, so the mortgage note market itself, it just involves buying and selling mortgage notes. Okay, which is pretty much a promissory note, which is secured by the mortgage itself or a deed of trust on the property. I kind of added that new verb in there for you so you can actually get used to the jargon here, which is that deed of trust. But the point is, it's pretty much just the market itself is just buying and selling mortgage notes, which is backed by the mortgage or the deed or trust of the property here, the promise to pay. Now, what we do here in this space, investors kind of like yourself, we purchase the mortgage notes to earn the interest income. All right. So that's how we get that passive income, that mailbox money. And what it potentially does is it gives us an opportunity to, buy properties or leverage um, the note itself to actually secure properties at a discount, when a borrower defaults there. Speaking of defaults, we touched on it before as it relates to the different types of mortgage notes. You have your performing and you have your non-performing notes. The notes themselves, when it comes to performing, these are just individuals, as I stated before, that are current on their payments. The borrower are they're pretty much making their regular payments on time. Those timely those timely payments are, in the terms of the actual note itself. We touched on the four components of a note during our previous session there in session one. But the performing note itself is just pretty much the borrowers making their regular payments, those timely payments within a specific time as it relates to the terms of the loan. Now, the non-performing notes, those are pretty straightforward as well as it relates to the non-performing. Those are individuals who are at default, where the borrowers have missed payments. It does present a higher level of risk, but it also has the potential for higher returns, as it relates to maybe through loan modification, foreclosure, or just a property acquisition overall. Um, so as we did that recap here, let's kind of just dive into the key players that's in the market at the moment. So some of the key players that you actually see are going to be your banks and your financial institutions, your private investors, your hedge funds and private equity funds, your mortgage note brokers, your government entities, and I'll tell you what. Let's take it a step further. Your banks and your financial institutions. These are the individuals who are primary, like the issuers of the notes. They often sell them to manage the risk and improve their liquidity, but the banks actually, initiate or they actually issue these notes. And in the case, you wonder how does it get to individuals like ourselves? The banks and the financial institutions themselves, they typically sell them to manage their risk and improve their liquidity overall. Private investors, they are pretty much key individuals in this space. Um, you may see individuals kind of like myself, Larry. Greg, and other individuals who have like small investment groups who actually look for high yield opportunities in the real estate market by purchasing these notes there. So you do have like private investors and the small investment groups that I will include the small investment groups as private investors as well. Now the hedge funds and the private equity funds, these are your larger entities where they kind of buy bulk portfolios. And later on, you may hear or you may see individuals say tapes as well. A portfolio is equivalent to a tape, okay? TAPE. Um, and what that pretty much consists of, that tape or that portfolio, those larger hedge funds and those private equity funds, they buy both performing and non-performing notes to diversify their investment properties. Not their investment properties, but their investment portfolios. So the larger entities like the hedge funds who have, anywhere over, let's just say in this case, 20 million. Okay. Let's say they have anywhere between 20 million plus, those are your larger ones. And then hedge funds in those space, they sell it to the smaller hedge funds. The smaller hedge funds sell them to mom and pop individuals. In this case, let's use mom and pop, which would be small investment groups like myself, LJH investment groups, the Silvercrest groups there. They sell those to the smaller ones. The Everly May Fund by Patrick and Desi, they buy these tapes here from the larger hedge funds. The government entities. I know you're wondering, why do I have government entities on here as a key player in the market? Because you want to understand that organizations such as Fannie Mae and Freddie Mac, they buy and sell mortgage notes to support the housing market and to ensure liquidity for the banks overall. All right. Again, those government entities like Fannie Mae and Freddie Mac, they buy and sell mortgage notes to support the housing market to ensure liquidity themselves. Um, I skipped over the mortgage note brokers as a key player in the space, just because those individuals, not in a bad way, but kind of just skipped over indirectly. But the mortgage note brokers themselves, they play a key role as well. They pretty much are like individuals who facilitate, um, the transactions between the buyers and the sellers, and they provide access to the market. As it relates to different information, they will be connected to different investment groups where you are looking to unload assets, or you are looking to buy or purchase non-performing, whatever your risk tolerance is, whatever your risk appetite is, as it relates to your criteria for buying notes. Now, some of the current trends in the market, by just staying on this slide here, um, it what we see in the market, with TIG legacy here, we see an increase in non-performing notes. We see more investors are looking to explore, the what we call NPNs, or like we said, non-performing notes, due to their high potential for high returns, despite their risks. A lot of individuals who are in the shared living community, coupled with the group homes, they are leveraging that as an exit strategy as it relates to maybe securing some non-performing loans to actually acquire the house. But we'll actually go through the life of a loan here in a few. We're starting to see some regulatory changes as it relates to the state of Georgia. In the past, you were able to own anywhere from 2 to 4 notes in your own private name. But since then, you need to make sure you're compliant with the different certifications required here in the state of Georgia. But if you what you really want to do is you want to keep an eye on the regulatory changes, because it actually affects the mortgage note community, um, when it comes to your portfolio in general, especially if you're someone that's just getting into the space and you maybe own a note, here and there. When you start to get over that 4 note criteria there, you want to make sure that you are paying attention to your state regulations as well. Technology, always talk about technology and the data analytics. What I'm starting to notice is actually an uptick of individuals who have very thorough, um, I would say, software when it comes to better assessing the risk value of the notes. Like for example, I touched on it earlier, the Everly Fund by Patrick and Desi there. They actually have a very thorough due diligence process that's actually backed by some technology as well to help you price notes, to help you understand, the criteria as it relates to your tolerance as well. You got other individuals out there like JKP Holdings, who actually has a very, very thorough due diligence, you know, type of technology as it relates to doing the data analytics associated with the notes. What I typically do is I pay attention to something called air DNA. Air The word air, D as in Delta, N as in Nancy, A as in Alpha. So air DNA, what I have noticed is because I do have group homes and I do have some shared living spaces, is that information I use to understand the market for the homes that's actually in the area where I actually own those notes. So I pay attention to the Airbnbs, the price points there, the different websites, verbal websites, different things of that nature, where you actually have these types of places where people can go and rent homes and different things of that nature. Because I'm always interested in leveraging a property, just in case I have to foreclose and acquire that property. I want to make sure that it makes sense for our portfolio and make sure it align with our short-term and long-term goals. But overall, you're always paying attention to that type of current trends in the market. Um, Alden of Silvercrest Opportunity, him and I actually did a roundtable discussion last Saturday around interest rates, the housing market trends. We actually did like a broader economics, deep dive as it relates to how these factors heavily influence the mortgage note market. So if you haven't had opportunity, he actually has some very valuable gems that he dropped in that. Covered as it relates to the current market trends. But overall, we're always looking for opportunities where we're looking at different regions with high foreclosure rates, because that actually presents an opportunity to acquire notes at a significant discount. And again, we're always looking for um, those types of deals where we can get a pretty good return for our investors. The secondary market, you actually starting to see an uptick of individuals who are unaccredited investors, people who are in the market. They're looking for ways to put their money to work or park their money in a vehicle that makes sense, like mortgage notes, where you actually have a uptick of individuals who are, buying and selling, notes, within each other, which is, it just gives an opportunity, going back to the slide here, for the mortgage note brokers to actually, make some money here overall. Um, when it comes to the life of a note, I actually came across this here, and I actually touched on here. Larry Hoffman of LJH Investments actually had a very thorough, um, what I like to call flow chart of the life of a note itself. Um, it's pretty much two pathways when it comes to a note. You have your performing, you actually have your non-performing, and it's just like, when I say, when it comes to the note origination, those banks, those financial institutions, they originate that note, and they actually lend that money. When they lend that money, that individual itself, they're either going to pay on time or they're not going to pay. In the case that they pay and you actually acquire that note, two options can happen. When they're actually performing well, which is, they stay with you, or they actually pay the term off of that note, or they actually go and refinance, and you exit that deal there in that nature. But the most important piece here is non-performing, in which is the three main pathways when something is non-performing. You have your short sale, where individuals are looking to, get a quick payoff. Investors leverage this, quite frankly, a lot. Then you actually have individuals where, you have to foreclose on the property, where it's going 60 plus, 90 plus days, where someone is in default. They actually avoiding you. They're not looking to answer calls. They're not answering door knockers. They're not answering, any correspondence from your servicer, as well. So you have to go ahead and foreclose on that property. And then you have your loan modification. I kind of touched on this before as it relates to um, a loan modification. That's something that every investor in this space does. We like to make sure that that individual can stay in their home. So what you would do is, in this case, and what investors do most of the time is they will reach out to the borrower and say, hey, send me over your tax returns for the last 2 years, coupled with your bank statements and any other financial documents that that you will call for. Because what you want to do is you want to see their relationship with money, and then you want to make sure that they can afford whatever the mod may be. So you may do a 3 to 6 month trial for a modification to see that that individual can pay or will pay the $725 that, in this case, let's say 725, a month for the next 3 months before you actually make that, that loan modification. You may put them on a trial run, and then let's say that they do complete that, that trial period. You'll go ahead during that time interval. You're, getting the documents, preparing the documents where you actually make that loan modification, and it's a win-win because now the investor, they have a performing note, and that borrower, the most important piece, they get to stay in their home, as it relates to them just being into their home, really straightforward. And then now you have a performing note where you can go and kind of like what I touched on before, when a secondary market, you can go and sell that note as a performing note, or you can actually keep it for your portfolio. But outside of that, that's pretty much the life of a note. Um, what we would do is during our next session here, we would likely dive into how
Oh, you're frozen a little bit here.
series. I hope that you have gained, some valuable insights into the mortgage note market and the opportunities that it actually present. Um, stay tuned. Like I said, next week, our next session, we would dive into a crucial topic of how to actually source these notes, and not we'll dive into how to source the notes. Effective strategies for finding and acquiring notes to build your investment portfolio. But until then, keep learning,
Yeah.
growing your financial knowledge, stay safe, stay healthy. And I'll punt it back over to you, Greg. Go ahead.
Yeah, no, that's fabulous, Maurice. And I know Alden's in the audience because he gave us a thumbs up. So I don't know if he wants to jump in and have a question, or anybody else has a question. The other thing is you mentioned Larry Hoffman, and on our roundtable discussion on Saturday, he's going to talk a little bit about partial notes. So that's an
Nice.
interesting topic. So that'd be great. And I'm assuming you'll jump on, and maybe Alden and a few others will get involved with the conversation on Saturday. But we're back here with your next lesson next Tuesday.
Next Tuesday, every Tuesday and Thursday, 3 p.m. Eastern Standard Time. We'll be coming, to you with a new idea of, or let's just call it our mortgage note summer school sessions.
Yeah, the mortgage note summer school sessions. There we go. Yeah, well, that's fabulous. And yeah, so it's happy Thursday, everyone. And
Absolutely.
thank you again, Maurice. That was great.
Thanks again. No problem.